Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at why consumer confidence has slumped so sharply when we still have record low unemployment. And we'll look ahead to see what it might mean for interest rates. And then we'll do some speculating about house prices. Just how much could they fall and how long before we see prices back at their levels of a couple of months ago? The answer is frightening for property investors and not that encouraging for first home buyers. But firstly, we delve a bit deeper into why we've seen such a stunning drop in consumer confidence in March. Westpac's McDermott Miller survey for the March quarter found confidence slumped to a 10-year low, and now pessimists outnumber optimists. This really is remarkable. Unemployment is at a record low of 3.4%. Consumer spending is still reasonably strong, and we're seeing an unprecedented boom in dairy prices. House prices are only slightly below their peaks from November last year and remain almost double what they were 6 years ago. And the last time we were this grumpy was in 1998, when we had over 200,000 people unemployed and we were in a sharp recession triggered by the Asian crisis and a drought. Now, we've just come out of the longest period of economic growth we've seen since the 1950s, and we have an unemployment rate of 3.4%. So why are we so grumpy now? The simple answer is we're moaning about higher prices and in particular higher interest rates. The difference this time around is we're so much more indebted than we've ever been. Since 1999, household debt has ballooned from around $70 billion or $50,000 per household to around $160 billion in total. That's about $100,000 per household. So household debt has doubled in the last 8 years. We use that debt to boost house prices and to go on a 7-year-long spending spree. We spent around $1.14 for every dollar we earned. House prices in that time rose 80%. So now we care an awful lot more about debt, about interest rates, and about the value of our homes. Most importantly, we care about disposable income. And lately the news has been bad for all of those things. Higher petrol and food prices are hurting, and so are higher interest rates. But the thing that is really depressing us is the end of the housing boom. The median house price is down 4% since November and is falling fast. So our disposable income is under intense pressure, and our main store of wealth is being eroded in front of our eyes. And the prospects for an improvement? Not much, I'm afraid. Interest rates are unlikely to fall this year, and may even rise higher if the global credit market turmoil continues. Petrol prices are likely to hit $2 a litre soon, thanks partly to high oil prices and also high taxes. And house prices have further to fall. More on that shortly. The key question for homeowners and property investors now is, when can they expect capital gains again? The simple answer is a long time, perhaps even a decade or 2 decades. Here's our prediction. We expect house prices will fall 30% from their peak in the next 2 years. High interest rates and low migration will force sellers to drop their prices to the point where it becomes affordable enough again for regular first home buyers to return to the market. Speculative property investors will also desert the market. Currently, it costs more than 80% of the median take-home pay to afford the mortgage on a median house. That needs to drop to 40% for housing to become affordable again. Given our wages are rising only slowly, then it's going to take a long time for our ability to service the mortgage on a home to catch up with the current house prices. So if house prices fall 30% in the next couple of years, we expect it could take at least another 10 years for prices to grind their way back higher to $352,000 peak we saw in November last year. It may even take 20 years if you look at our trends since 1980. So anyone who bought at the peak expecting capital gains will have to assume at least another decade of waiting. This is more pessimistic than many analysts who are forecasting just a year or two of price falls before things get back in the swing of things in 2010. Our bet is don't expect capital gains until 2018 at the earliest, and maybe not until 2027. On that cheery note, I'm Bernard Hickey from interest.co.nz with the Daily Briefing. See you on Thursday.